Let's welcome in the banking fund manager now, Vinay Sharma, fund manager at Nippon India Mutual Fund, is now with us. So a lot of companies have declared numbers, and arguably or on expected lines, NIMs, have been on the better side. Can you just talk to us about the NIMs trajectory that you are predicting, or what to watch out for in the coming quarter for NIMs to be maintained?
Yeah, hi, good morning. Thanks for having me on the show. We believe there would be some bit of margin compression as we go ahead along the quarters this year because deposit rates have obviously jacked up in the system, and because of the impending big merger, there would be some pressure on deposits in the overall system, and therefore as deposits get repriced in the balance sheets of banks, there could be some marginal pressure on margins. But having said that, what we are looking for the next few quarters is one, this steady growth continues. Obviously, last year was a Goldilocks scenario, so we are not expecting the same high mid-teens growth. We are expecting closer to mid-teens or slightly lower than mid-teens growth in the banking system this year. But if that sort of steady growth comes with no spike in credit cost, and even if a little bit of margin hit takes place, even then banking earnings would be quite resilient compared to most of the sectors in the system. And that is what we are looking forward to, resilient banking earnings and no spike in credit cost, and probably a little bit of slowdown in overall growth for the system.
One, of course, is what you're talking about, earnings, how things are moving in. Second, of course, is the macro environment plays a very, very important role. Now there is a consensus view that rates probably in the system may not go up further from here on, or they seems to be on the flattish side and maybe decline towards the next year. Say if that is your thesis as well, how would you change your positioning? Would you look at lower CASA banks? How would you look at names, or what kind of banks would you now look at?
So over the past few years, we have preferred banks over NBFCs. That has been a clear preference, and even in banks, we preferred corporate banks over retail banks, given that those banks were coming out of a big NPL crisis 3-4 years back. However, the scenario has changed a lot today. That differentiation between corporate and retail banks has practically ceased to exist, because even though the erstwhile corporate banks have become more retail in nature, almost every bank has between 50 to 60% of their balance sheet in retail loans today. Therefore, what the from a stock perspective, the choice is more bottom up now, rather than classifying them into subsectors. And NBFCs are starting to look a little bit more attractive given their valuation, growth prospects, and as you said, interest rates might start to cool off, and therefore their liabilities cost could come down over the next 1 or 2 years. So our preference is still large private sector banks. That is probably the number one preference in pecking order, followed by the large PSU banks, and then followed by a little bit of NBFCs in both asset financing as well as housing finance sectors.
Right. In terms of, uh, since 2019, the consensus in the market was that, we only want larger size banks. We only want banks who can manage cost, who can manage a little bit of slippage here and there. You think that's changing in? You think smaller banks is also something where now valuations are attractive?
So again, one has to be stock specific, because if you notice, last 1.5 years, the small and mid cap banks have actually done quite well, and valuations have moved up across the board. Having said that, we believe they are. If you look at the balance sheet profile of some banks, those profiles are quite interesting, and some of those banks can show higher growth than the system for the next 2-3 years, given that we are expecting a benign credit quality scenario and reasonable growth outlook scenario. So having said that, I think one has to be stock specific. There are a few stocks that look attractive at this point of time, even in the mid cap and small cap segment. But it's not like we prefer small, medium over the larger ones at this point of time, or we prefer larger ones over the smaller ones at this point of time. Obviously, given the portfolio size and the liquidity, larger banks are always a large part of the portfolio, and valuations are reasonably attractive there as well. So That's what I would like to say on this.
I just wanted to also get in your thoughts then on HDFC Bank in particular, given that the RBI has allowed it to meet the priority sector lending requirements, what the impact is going to mean for the merger as well going down the line?
So, as you know, we can't really talk about individual stocks, so I won't be able to comment on this. But overall, as I said, large private sector banks valuations are reasonably attractive at this point of time. And given the overall outlook of the market, where we see pressure on the global sectors, given the impending slowdown in US and Europe, and the slowdown in IT that we have seen from the large cap results, and the way I talked about earning resilience of financial system that we are expecting, we believe large private sector banks could be a good pocket of decent earning potential as well as reasonable valuations.
When you look at banks as well, you can come down to top three, four banks. I understand you cannot talk about stocks, but there are pure banking plays. There are banking plays with a lot of large insurance company, mutual fund company. In the current environment, now that NIMs have expanded, how would you like to play? You would like to play with companies that have a higher fee-based model as well?
Well, frankly, there are hardly any banks in India who are not financial conglomerates as of now. Almost every bank has a large insurance subsidiary or some asset management subsidiary or some of the other parabanking businesses. But if you look at those parabanking subsectors as well, insurance, mutual funds, and the securities arms that those are listed, valuations become attractive there as well. And if the cycle doesn't turn out to be as bad for capital markets and the sort of projected slowdown in insurance is a lot less than what people are expecting or what market is expecting, then there is reasonable comfort on valuations in those parabanking sectors as well. So as of now, there is not a clear difference between pure banks versus conglomerates, but conglomerates look interesting because the parabanking subsidiaries have corrected over last 3-4 years and they have not delivered any returns, and valuations are fairly attractive. We would say.
All
Right.
right. Just give us a sense as to what your outlook is when it comes to the asset quality concerns for some of the banks. Do you believe that this is now behind us, or are there any select banks that you believe that this could be a lingering concern for?
So if you look at it, and I'm not sure if I'm right on this one, but someone just told me that some of the PSU banks have now net NPAs below 0.5%. That is as good as it gets. And surely over the next 1 or 2 years, marginal deterioration in credit quality can happen. But across the large segments that Indian banks cater to, whether it's corporate, whether it's housing, whether it's retail loans, we are not seeing any signs of stress building up or any signs of over leveraging. Probably corporate India is it in best shape that I have seen in my career over the last 15, 20 years. Their debt to GDP of BSE 500 is it's almost at its lowest in the last 10 years. So frankly, we are not seeing stress building up in any of the large industrial segments or any of the large personal segments. So from a quality point of view, we are fairly convinced that next 1 or 2 years, chances of a asset quality shock or the stress in credit quality are fairly low.
All right, let you go on that note, Vinay. Good to have you on board discussing the outlook for the banking sector as a whole. We'll